Welcome to today's deep dive.
Yeah,
And we're diving into something I think a lot of us remember pretty vividly, the 2020 market crash. But we're going beyond the headlines.
absolutely. We've got selections from Fed Up by Colin Lancaster. He was a hedge fund trader during all of this, right in the thick of it.
So he has a pretty unique perspective then.
He does. And his book, it's not just numbers and charts. I mean, we get the inside view of what people were actually thinking, the decisions being made, even the toll it took.
You've highlighted some parts early on, even before the pandemic, where Lancaster's already feeling uneasy about the markets. And this is before, well, most people even saw a crash coming.
Right, right. Lancaster is already seeing what he calls an everything bubble, like low interest rates, tons of debt, and this sense that the markets, they were totally detached from, the real economy.
And he's seeing echoes of past crashes, but like on a much bigger scale this time.
Exactly. It's like, how big can this bubble get? And then there's this phrase he uses that really stuck with me, like doing a deal with the devil, talking about quantitative easing.
Okay, so for our listeners who aren't, Wall Street insiders, break that down a little. What's the analogy there?
So QE, quantitative easing, basically means pumping massive amounts of money into the economy. And in the short term, sure, it can stabilize things. It's like, think of it like giving the economy a shot of adrenaline. You might win the race, right? But what does that do to your body long term? Those are the questions Lancaster's asking.
So it's a temporary fix, but with potentially dangerous consequences down the road.
Yeah, that's the implication.
And he illustrates this point with that anecdote I think is about shoppers at Harrods, right?
Yeah, okay, picture this. Harrods, one of the most luxurious places you can shop in the world. And this is with a global crisis looming, right? Lancaster is watching people buy diamond-encrusted whatever, paying with stacks of cash.
Just like another day at the office.
Right. And for him, it's this stark illustration of how disconnected the financial world, the markets are, from the struggles of everyday people. This wealth inequality that he argues that's fueled even more by policies like QE.
So it's like a warning sign that something's not right, that things are out of balance.
Precisely. And then, well, the pandemic hits. And that warning, it becomes a reality.
And everything just explodes. It was really interesting how Lancaster captures that raw emotion of those early days, that fear, the uncertainty. There's that line where he just says, "This is the day I want to vomit."
Oh, it's visceral. And it just underscores that feeling of pressure, that he and everyone else was under. But it's not just the emotional side. Lancaster is also critical of how some of the leaders, how they reacted or didn't react.
What do you mean?
He felt their initial response was just too slow, too hesitant, and that actually fueled the panic even more. He specifically mentions Lagarde at the European Central Bank.
And this is where his point about a globally interconnected economy really hits home, right? He uses the phrase, "When China sneezes, the rest of the world gets sick." It wasn't just a problem contained to one part of the world anymore.
Exactly, and I think we saw that play out in a really stark way. 2020 showed just how interconnected everything is. A virus starts in China, and it triggers this global economic meltdown, like that domino effect. What happens in one corner of the financial world can ripple outward.
So you've got this crash unfolding, panic is setting in, everyone's looking for answers. But what I found really fascinating was how Lancaster describes his own thinking during this, like actually sitting on the trading desk with millions, billions even, on the line.
He goes deep on the psychology of it,
Yeah.
because you have to stay disciplined when it feels like everything is falling apart. Everyone around you might be losing their cool, but you've got to stick to the plan. Having a clear strategy, that's crucial. Managing risk. These things become so important when the markets are behaving irrationally.
And he even compares it, I think, to being in a car accident, right? That feeling of, here we go again.
It's 2008 all over again. Like being in a car accident, yeah, that's the line. And for him, the experience of those previous crashes, it's weighing on him. He knows what's at stake. So it's a powerful analogy, that sense of bracing for impact, even if you've been through it before.
Definitely. So for someone listening who might not be a trader, what are some of the key takeaways? Like if you want to navigate a crisis, especially when it comes to your own money, your own financial decisions, what does Lancaster say?
Well, he really emphasizes preserving capital. Like, rule number one, don't make these rash decisions based on fear, just because everyone else is panicking. Easier said than done, obviously. But if you have a plan, try to stick with it as much as possible. Weather the storm. He also talks about adaptability, being able to change direction quickly, because in a crisis, things change fast.
He uses that term inflection points, these moments when everything can just shift on a dime. What did he mean by that? And how do you even spot those?
So inflection points, they're like these seismic shifts, in the market, like a change in a trend. Maybe there's a new policy announced or something happens globally, throws things off. Anything that really alters the course. Lancaster seems to say that good traders, they're kind of like, almost anticipating these inflection points, constantly analyzing data, the news, what's happening around the world to stay ahead of the curve.
So it's not just about like understanding numbers, it's about understanding the bigger picture.
For sure. He says that macro trading, which is what he does, it requires this deep understanding of global affairs, economics, politics, because it's all connected.
Okay, so the markets, they eventually stabilized,
Right.
right? Recover. But Lancaster is still uneasy about the aftermath. And this is where he uses that phrase, one of the greatest wealth transfers of all time. And he even links it back to his own, upbringing, his hometown of Detroit.
Yeah.
Right?
Yeah, this is where it gets really interesting. He argues that while the Fed might have prevented total meltdown, that their actions actually made inequality worse. You know that saying, a rising tide lifts all boats? Well, this wasn't that. The recovery seemed to mostly benefit people who were already wealthy, while millions of others were still struggling trying to recover from job losses and all the economic fallout from the pandemic.
In Detroit, he's using that as an example of this.
Yeah, he talks about how Detroit, a city that's faced its own economic hardships, it becomes this example of a larger trend. He's seeing this disconnect between what's happening on Wall Street and the struggles of everyday people, even in his own hometown.
You highlighted this quote. The markets are back at their highs. It has turned into one of the greatest wealth transfers of all time. It's almost like a warning. Like the recovery itself is masking something much bigger.
It's a powerful statement, and it gets at the core of Lancaster's critique, because he's suggesting that even with good intentions, even if the Fed saved the system, there were these unintended consequences. And one of those was this widening gap between the haves and the have-nots.
And it's not just about, like you said, numbers on a spreadsheet. This is about the rising cost of housing, of education, of just basic necessities. It makes it even harder for people to get by.
Right, exactly. He argues that all that money the Fed pumped into the economy, it devalued the currency. And when that happens, everyday people, they're the ones who feel it the most. Everything costs more.
He even compares it to another period in history, the Gilded Age, which is not something you hear every day.
It's a fascinating parallel. Lancaster goes and visits these lavish mansions, these cottages, they called them, built by the super wealthy during the Gilded Age. And it's like this stark reminder, this visual representation of that era, right?
Right, like those old photos of the robber barons with their yachts and their, what were they, champagne fountains?
Exactly. And Lancaster is seeing those echoes of that time in her own time, this concentration of wealth and extravagance, while so many others are struggling. He even quotes Shakespeare, talking about gilding refined gold to kind of highlight the absurdity of it all.
It's like, how much more gold can you possibly need?
Ugh.
But it goes deeper than just a history lesson, doesn't it? There's almost this warning about what happens when things get this out of balance.
Right. And he points out that after the Gilded Age, you had the Panic of 1893 and then a depression. He doesn't come right out and say, hey, this is going to happen again, but it definitely has that cautionary tone. Like, are we creating the conditions for the next crisis, even as we're still recovering from the last one?
So we're seeing these parallels to the Gilded Age, and it feels like, history might be rhyming here, if not repeating exactly. But then Lancaster throws another log on the fire. He brings up this idea of modern monetary theory, MMT.
And this is where it gets really interesting, because you can almost sense him wrestling with it in the book. Like,
Yeah.
okay, with MMT, governments can basically just print as much money as they need, and we don't have to worry about those old rules of inflation.
Which on the surface sounds great. Who doesn't want to just print their way out of problems, right?
Mm.
But Lancaster seems really wary, especially when he brings up those historical examples, like hyperinflation.
Yeah, those cautionary tales. He talks about Weimar, Germany, or Zimbabwe more recently, places where they hit the print button a few too many times and the whole system just melted down. So he seems to be saying, look, MMT might sound good in theory, but in practice,
Big difference.
right,
Right.
could be disastrous. And what I find interesting is that Lancaster, he doesn't pretend to have all the answers. He's laying out this dilemma. Unprecedented actions by the Fed, potential for things to go really wrong, these new economic theories popping up. And the question he leaves us with is, what happens next?
That's a good question.
It is, because if this was the outcome when the Fed, went all in, threw everything they had at it, what happens the next time a crisis hits? Will those same tools even work? Or are we facing something totally new? something maybe even more challenging.
It's a bit of a scary thought.
Yeah.
And it makes this deep dive into Fed Up so much more than just a history lesson. Like, it feels incredibly relevant right now to the choices we make for the future.
Definitely, because behind all the market talk, the policies, the headlines, there are real people, real stories, real consequences to the decisions that get made.
Absolutely. This deep dive has been, well, eye-opening, to say the least. It's given us a lot to think about, not just about the 2020 crash, but the whole picture. The economy, the role of government, and even, like you said, the risks of well-intentioned policies. A big thank you to you for sharing your insights with us.
My pleasure. Always good to be here.
And to our listeners, thanks for taking this deep dive with us. We'll be back next time with another fascinating look behind the curtain.